Welcome back to the lab. So, we've been talking about this for how long?
I don't know, man. You're my guy.
Oh, it lies.
It is.
I feel neglected.
You know what?
I feel neglected.
We're massively busy, and if it's not in my calendar, it's never happened. And I feel like when you sent me that calendar, I go, I got to do it now. I'm going to put it in the calendar. Once it's in the calendar, that means this is like a real thing. And I don't know why I didn't do that before, but we're here, man. It's timing is everything.
It took me a while to set up the automations on that.
See, I wanted to become one of those perfect. Everyone before me, I'm sorry, guys. You guys are all the beta testing. This is the real.
It's a strange thing to do what we do every day because we speak in front of people all the time.
Yes, we do.
Like groups, right? But it's another thing for us to sit down and actually have like cameras involved, and it's just so memorialized.
Yeah,
you know, because if I'm out in the field and I'm just bullshitting, I'm like, no, I can remember that,
dude. I don't even see the cameras. You know what? It's like, I mean, you know, I do a lot of Instagram stuff, right? A lot of videos, and we were talking about this off camera. Like, I don't give a shit. I shoot it one time. Yeah. If I fumble my words, it's like everyone, maybe it's cleaned up, whatever it is. I just feel like be yourself. People want the information regardless. And if you can give it to them and if there's a pause or an like no one really gives a shit, you know?
So let me introduce my good friend here. This is the one and only Sid. And he is the appraiser of choice.
Damn.
Now, are you a master appraiser or just a straight appraiser? Because I know there's designations for appraisal levels, right?
Yeah, there's designations. I am a master appraiser.
You are a master appraiser?
You know what? Here's the thing. If someone asked you, are you the best at what you do? What is your answer?
I'm a black belt.
There it is.
Yeah.
But it's not, I'm not just saying it. So I don't want to like toot my own horn or people like, I'm super confident, but you know, I just came back from Vegas a week ago, 4-day convention.
Yeah.
I'm putting in the work, right? And so I'm putting myself in front of people like yourselves, educators, people who are better than me. You gain a knowledge base. I've been doing this 20 years. So when people go, I go, I'm the best. Not because there's not someone else that can also price out this property like I would, but I'm putting in the work, doing the daily grind. I mean, you know, I've brought in people into the business, and I think once you can do that, and I was telling this to my team today, I go, it's one thing to conceptualize it, it's another thing to articulate it.
Yeah.
You know, so once you can actually teach a group of other professionals, they see you as the expert, then I'm a fucking expert, right? and that's
10,000 hours makes you an expert.
Sure, yes, maybe, but I think you can cut that time if someone is already an expert and you're under their wing and you're putting in that same work that they are. Could you cut it to 7,500, 5,000? Maybe, right? Yeah, good. But I think perception's everything. So people see that, oh, this person's been around, they've been doing it, they've gone through the turn of the market in 08 and maybe the market prior to that. I don't know how long you've been doing it, but it's like, I feel like, yeah, you know, maybe I'm one of the best, but in this market, yeah, for sure.
Yeah.
Find someone else.
You know, it's funny, and I tell people this all the time, and I think when you and I started working together before was that, you know, I've never really wanted any of my appraisers to ever come in at the value I needed. Because I felt not only was it not the right thing to do for the client, it's not the right thing to do for the marketplace, just in general.
Okay.
Because I want to be able to sleep at night knowing that the value that is what it is independent of me.
Yeah.
Right?
Without persuasion.
Without nothing.
Yeah.
And one of the things I've taken away from that is that as I start looking at how valuations are coming together or the justification for a specific valuation, it allows me to have better or more honest dialogue. It's like, oh, hey, bro, you didn't make an adjustment because it's on a busy street, or, you know, this property actually has a view and it's been renovated. And there's a lot of appraisers out there that don't take the time, energy, and effort based on where they're pulling their information to stop and look at photos. They're just pulling tax rolls.
Yeah.
Right?
Yeah.
Or I think even like from agents in our business, and this is no knock on agents because I know a lot of agents will do this, price per square foot.
Yeah. Which is, look, it's a starting point, right? And so, but there's other factors that are also involved, right? Because in some markets, like let's say Coronado, you have 1,200 a square foot, you have 2,000 a square foot, you have 3,500 a square foot, all in the same island, right?
Yeah.
But I feel like you're right. I think some appraisers hit a number, and it is a disservice not only to the buyer, it's a disservice to the agent, right? And so here's the thing: I don't know what that buyer's going to do with if they have equity coming in. So sometimes I appraise a property and I'm like, oh, that agent left money on the table. What does that mean? Meaning they didn't sell it as high as they could have because I appraised it higher than what the contract price is.
Yeah.
So I think people have a misconception on what is value versus price. Value, like is what most people would pay for a certain product, not under duress, like arm's length transaction. But if you start setting, if someone goes, oh, I paid $150,000 over for this over contract, that's not market value, that's market price, and we actually discount those prices, right? Oh yeah, absolutely. So here's the thing. There's something called like cluster of sales, and then there's outliers. So within a cluster of sales, you may have, let's say, 850, 875, 925, 915, 840. And then you have like a 1.1 on this array, and you have this other one that's like at 450. Right? So those are what we call outliers. The 1.1, I'm going to call the agent, hey, this property sold for $150,000 over anything else in the market. What happened here? Oh, that person paid $150 over the contract price. Perfect. So I take the 1.1, I minus the 150, and then I'm probably back around where the cluster of sales are at, right? So we have to pay attention to outliers. Is there a reason? Is it the diamond amongst all the other jewels in the neighborhood, referring to houses here, right? Yeah. And then because there's also, and I talk really fast, but there's also something called like comparable properties, comparable, and then competitive. Comparable is like tract homes all over in any neighborhood all over the United States.
Like type to like type.
Exactly. Like just think tract, KB home, whatever. No plug to KB, but hey, if it's going to help me out, you can sponsor me. Right. So
Lennar,
that's another good
Toll
one.
Brothers.
Yeah, we're not getting paid for these name drops, guys, right? It's just the first one that came to my mind. But the thing is, then you have competitive. Competitive is like the home that's waterfront with the tennis court, completely tricked out, has all these like amazing features. That's what we want to find. Now, I can go 35, 50 miles away from my market area to find that competitive comp and then do cross analysis comparison on location adjustments, and then say what happens in market B, I can assume that happens in market A because locationally they have the same features. If I can't find something that's within, a close proximity to my property, if that makes sense.
That makes total sense.
Yeah.
But I feel like the market has gotten so tricky now where a good one's like ADUs. Like you and I have been talking about ADUs for a long time, and units
probably like almost 6 years, but yeah.
Right?
Yeah.
How a lot of people get the misconception how a single family with an ADU versus the duplex and using those as comparables.
Yeah.
And I run into this all the time.
Well, what do they say about that? What's your take on that?
Well, it's there's a couple different things, which is really crazy. So like now, since the municipalities will allow a multi-unit property to have an ADU. So a duplex can now have an ADU. The agent will put that property on the market and list it as a triplex.
Yeah. Okay.
Okay. Now, from the financing standpoint, and a lot of people don't know this, so from financing standpoint, Fannie Mae treats those properties as ineligible. You can't have a 2-unit with an ADU for conventional financing.
Why is that? Because here's the myth behind that.
Well, that's actual fact. That's actual Fannie Mae, Freddie Mac, ineligible property type.
Okay. So as I explained, I was at this convention and I asked Fannie and Freddie, I go, hey, how do you guys treat this? And they didn't know. I can tell because they were like walking around the topic.
Read the guidelines.
Yeah. and so, okay. So they're like, well, if it's more than 4, then we don't lend on it as far as convention. Like, okay. So if it's a triplex with an ADU, is that still considered it's under 4 units? Because then there's that whole thing where, is it an ADU an actual unit? No, it's an amenity. And it's an accessory to the property. But on an income approach, yeah, I would say if you had a duplex with a ADU, it'd probably rent the same as a triplex. On an appraisal standpoint, slightly different.
On a cash flow analysis, you can use it as cash flow analysis wise.
Okay.
But it is ineligible in terms of property type. So think about this.
Okay.
Back in the year 2000, nobody had solar. And you had that one house that had solar.
Yeah.
How do you give it value?
It can be seen as an over improvement,
right?
Or we have to put it on the cost approach, and then we do depreciation on the home, and then cost new of the solar, and see how that factors in.
But for the solar being the one type, it's difficult to come into the valuation when there's no additional comparables.
Exactly.
So Fannie Mae's standpoint is, well, how many duplexes can you really put on that appraisal that have ADUs to compare it to? Right? So neighborhoods in specific. So let's say go Logan Heights, which is more like an inner city, fixer-upper neighborhood. Let's just put it that way, right?
It's on the rise.
It's on the rise.
But I think because the Chargers went to LA, it stopped all of that because prior
it was going east.
It was going east. It was passing East Village. Everyone's like, Logan's going to be the next one. And they go to LA and I'm like, well, there goes that. But okay. Yeah.
But in Logan Heights is a good example.
Okay.
You have these really old houses in the 40s and 50s that have one-car garages converted to ADUs. Mm-hmm. And so the valuation on an ADU in that neighborhood is maybe $50,000.
Yeah.
You might spend $100,000 to build your ADU out, but now your comp has a $50,000 ADU ad. It's not going to necessarily give you the dollar for dollar value add because of what the market demographics is like, right? And I'm picking out the neighborhood only because there's a lot of those workmen.
Call it what it is.
Workman-like manor property.
I love the term workman-like manor. It's like the get out of jail free card for appraisers. We're like, well, it appears to be done in a workman-like manner. Like, what is the other manners? I've never heard of another manner.
Well, the electrical is in extension cords. Is that fair enough?
I go, well, the inner lining of that electric cord hasn't been exposed, so it looks fine to me.
The end of the cord is like stapled to the wall.
Oh,
or
my
has a nail folded over it.
I should write a book on what I see when it comes to appraisal inspections. I guarantee you it'll surprise you.
Bro, I saw a house in Claremont. From when you walk in from the garage to the kitchen, you know how normally it's like your washer dryer hookup?
Yeah.
They converted it to a shower. So you walked in and you just saw a shower, double door shower. And you walked into the kitchen. And I walked in and I saw the agent, and the agent was like,
"Did you take a shower?"
No, I didn't. I'm like, let's see. But I'm like, how random is this? You're out with your groceries. Hey, babe,
Go through the shower to come to the house.
I guess.
Interesting. Maybe that's like I don't know. Maybe that's like a what do you call it? An occupational thing. Maybe they were like a firefighter, and you're like, let's put a surfer. Same as a firefighter, right?
That's close enough.
I mean, it deals with a lot of water and saving lives.
Splashing in water.
Here's your point, though. Okay, the ADU thing. It is a big ticket item. I feel like a lot of people don't know how to add a value to it. But I think what the market needs to understand, whether you're a real estate agent, loan officer, appraiser, is market acceptability. Mm-hmm. So in any appraisal scenario, there's three things that need to be honed in on. You need marketability, acceptability, and conformity. Yeah. Okay. So marketability is like, was it placed on the MLS? Was it marketed on the MLS? Yes, that's one. Okay. Did it sell? Okay, that's chosen market acceptance. Mm-hmm. And then if it's sold, obviously there's probably comparable. So that shows conformity. There's other things like it. So even if it's like a non-permitted addition, non-permitted garage conversion, what we're trying to find out as an appraiser is, what is the contributory value towards the non-permitted space? How do we do that? So I have a perfect example, and a friend of mine has a listing right now in Bay Park. All right, it's being marketed at 2180 square feet. I'm sorry, I won't say your name, but it's all good. It's marketed at 2180. By the time this drops, the property will close. They
won't see this.
Okay, cool. Hopefully they will see this. So it's 2180 square feet is how it's being marketed, right?
Okay.
In actuality, the house is actually 1945 square feet. So 235 square feet of it is non-permitted. Let's say enclosed patio. It's a great space, but it's just non-permitted. So what happened is she's now representing both sides. Okay, so on the agent preferred page on the MLS, it shows like, yes, there's 235 square feet that's non-permitted, the agent preferred. But now she's representing the client. On the client preferred, everyone knows you can change the preferred on the MLS. They don't see that. So they're like, hey, we don't mind paying for this property, let's say $800 a square foot, but it's 1945, not 2180. And then she has to explain that. And so we had this conversation yesterday. I go, there's three things that need to happen. And she said, what is that? I go, what are homes that are selling for at 1945? What are those homes selling for? Let's say it's 1.1. Mm-hmm. What are homes selling at 2180? Let's say 1.25. So now there's a gap of 150,000. So the question is, the 235 square feet of non-permitted space, what is the contributory value towards that? Well, first we have to find the values of either side and then figure out, is there enough comp data on the MLS to show, yes, a home was marketed as being 100 square feet of non-permitted, 500 square feet non-permitted, whatever that is, and then attach a price per square foot towards a non-permitted space and then apply that. So it could be at, let's say, 65,000. So you're going to add the 1.1, now you're at 1165. You're far away from 125, not that far, maybe about 85,000. But that's the question. What is the contributory value towards non-permitted? It's not going to be dollar for dollar as it is permitted. Now, I understand maybe a lot of agents won't be able to understand or conceptualize that, but either side, it's
no different than converting a garage without permits. It's loss of use.
True. But with the garage, right now, we're like, okay, what is the value of the garage in that market area? Let's say it's 25 grand for a 2-car garage, and then the added value for the conversion is 75. Well, it's not 75 value; it's net 25. So you're at 50 grand you're going to get for that non-permitted space. So it's like, what I always tell people, it's like you have to set the intention for both parties.
Yeah, it's plus minuses.
Oh, for sure.
It's plus minuses.
Right? Because the
obviously.
seller doesn't want to feel like they're giving away 235 square feet.
Yeah,
and the buyer's like, well, I don't want to be held with this 235 square feet.
I'll share with you something kind of scary now.
Go for it.
So because like I just told you about the duplex, 3plex, 4 units, if you add the ADUs, this is just the way the perception is in their writing. And the reason I bring this up is because eventually, whenever loans go sideways, the first person they're going to come to is a lender.
Yeah.
And then they start doing the discovery.
Yeah.
And they're like, hey guys, look at that. And then obviously try to chase
Then
down.
they come to me.
Yeah, exactly.
And they
They'll
want to
come back
sue
to you.
me.
Exactly. So I'll share this with you.
Okay.
So maybe I should be at the Fannie Mae thing and break this one down.
Okay. Yeah.
Did you know that if you do a junior ADU, you get a deed writer on that property for owner occupancy only?
Yes.
Okay.
Well, if you rent it, you have to be on primary, it has to be on site, right? Is that what you're saying?
Well, when you go to get your junior ADU, that comes with a deed writer.
Okay.
Okay. So now it has to be only owner occupied buyers.
Yes. Okay.
Right?
Yeah.
Okay. If you add the detached ADU, which is allowable, so now you have 2, now that property becomes ineligible for Fannie Mae and FHA financing.
Why though? Why is
Because you're only allowed one
ADU?
One ADU. So in a situation like that, like as an example, a DSCR loan, the DSCR loan is one of those debt service recovery loans. It's very similar to like a commercial loan.
So it's based on income.
Based on income.
Okay.
They'll value that property based on the income approach. Because now you have
3 units.
3 units.
Yes.
They'll use the income approach and that standard for that specific loan type, right? But if somebody were to buy that property and try to go in and get Fannie Mae or FHA financing or any other type of traditional financing, by the time it gets back to the underwriter or the QC check, they're going to see it and be like, that's ineligible. You can't have more than 2 ADUs. Interesting, right? So I see a lot of these ADU companies obviously pumping out what the municipalities allow, but nobody actually sits down and talks. When I was on the board for the county and for the city for a while, I was explaining some of these things to them so that way they wouldn't get themselves caught up, right? But COVID hit and whatnot, so stop doing all that.
Yeah.
Sad. Because I'm like, oh my God, these people are going to have such liability down the road.
Yeah.
Because I would be pissed if I can't refinance my loan from a 7% interest rate, and now I have 2 ADUs on my property, and now I'm stuck with it.
Can you ever transfer that junior ADU into
Bonus room?
a studio bonus room and take it and remove it as a qualified junior ADU?
Technically. So that's
and a second part B of that question is, how does someone attain financing then if you can't do conventional FHA or Freddie?
Non-conforming, non-QM, all the higher rate, interest rate type of stuff. People that will look the other way.
And on average, for me and for your listeners, what is the difference right now in a QM, non-conventional, versus what's happening right now?
So there's 2 spheres. The main sphere is the QM mortgages, which is part of Dodd-Frank. So 2010, Dodd-Frank came out with the guidelines.
Can't stand Dodd-Frank.
Yeah. Well, right. So they came up with these guidelines and said, okay, in order for you guys to get your pool of mortgages to fall into these guidelines, it needs to be what's called a QM loan. QM is just a qualified mortgage. It just meets conforming guidelines.
Okay.
Within QM, you have another layer. It's called ATR, ability to repay. Okay. So ability to repay traditionally was pay stubs, W-2s, bank statements, tax returns, full doc, right? they started getting a little lenient on that when we started to say, well, since you're 1099 and you're showing these deposits from your Uber driving and whatnot, just show us your bank statements as your form of income.
Got it.
Then we started doing the 12-month bank statement, 24-month bank statement type of deal.
What year was that when you guys started?
That was probably maybe 5 years ago we started doing some of that.
Okay.
5 years, give or take.
So it's the new form of the stated income?
A method.
Okay.
It's a method. Then you fast forward. Now they treat the property, the SER, as an investment property. And based off of what the rents are in the marketplace on a 1-to-1 ratio, that's the maximum monthly payment the property can have in order to obtain financing.
Got it.
So now, typically, I mean, you're going to want to put at least 20, 25% down. Most of them ask for that.
Yeah.
Because it won't even debt service to begin with. But you can do things like Airbnb, cash flow analysis to justify the valuation because the value is coming in so high.
Yeah.
And it's covering the debt servicing for that loan. But you see now how if you squint and you hop on one foot and you spin, there's a loan there.
Or you could just show, I have leases in place and you base it on those leases.
I just posted something this morning that even we used to do that. We were doing that. Trust me. I'm not going to share all the trade secrets.
Let's make the deal happen.
Let's make the deal happen. But even if you provide a lease right now, day one, you have to show at least 2 months of deposits of that lease amount.
Okay.
So if you're renting it out to your cousin Pepe, and you're giving
I have
him
a cousin Pepe.
Okay.
Yeah.
I have an Uncle Pepe. But if he's paying $1,800 a month, but the fair market rent's $3,200, right? And hey, Anthony, I need to get my loan on this thing. And I'm like, well, you're collecting $1,800 a month, right? If it's on your tax returns, you're done. You're going to go off tax returns.
Got it.
Okay. If you have a lease that's fair market for $3,200 a month, so you kick Pepe out next month, you now have a new tenant and you're paying $3,200 a month.
Yeah.
You can use the $3,200 a month, 75% of the value. But the next layer that just came on is 2-month payment history that person that's on the lease is paying that $3,200 a month. You can't just provide an arbitrary lease now to get that dollar figure in. You have to be able to show proof of that ability to receive that income.
How long does it take to actually process a loan for DSCRs and things like that? The structure you're talking about, are those usually 60, 90-day periods? Are they 30 days? Like how does it?
I mean, the loans themselves, I think I was looking on average, we're like 22 days on average overall pipeline.
Got it.
22. But the caveat to that is we document everything up front day one.
Yeah.
So before I'm working with a bunch of agents out there. So day one, before they even get into someone's car, we're fully docking them day one. Plus, because this market condition is so tricky and we're pushing ratios so high, if I'm using commissions or bonus income or whatever method that we're trying to get the maximum amount, I had to almost get it to the dollar, right? Because it's that critical. Now, again, rates went up, prices are up, people are riding the razor of qualifications. If they find an HOA that's $450 versus $350, they may not qualify.
Yeah.
Right? So
and then now, because you're also speaking about the whole insurance game,
which is another animal, bro.
Which is like you not only you looking at the HOA, but you're like, will this development qualify for insurance? And that's a whole other animal no one's even thinking about.
That's why I was bringing up the thing on the ADU piece, because the ADU piece with the junior, without knowing the ramifications, it's great as the owner because now you got the extra cash flow. Awesome, high fives.
Yeah.
But the city let me do it. Awesome, high fives.
Yeah.
Did anybody ask the lender?
You know what? I'll take it one further. When I said that you need conformity, there's not a lot of single families, ADU and junior ADU.
San Diego State.
Well, San Diego State, for me, in my experience, has been they max out 1,200 square feet because they can put 4 to 5 kids in that spot and they're charging $1,200 a head. Do the math, right? Yeah. So they're like, oh, we're going to rake this in, which is totally fine.
Yeah.
And it's also, I believe, in the
my college area.
Yeah, college area, exactly.
So, but that's the thing. So a lot of investors that move into that market area recognize that there's a high probability of rent and you can rent out smaller spaces for good top dollar. So it makes total sense to max out your square footage, to add the junior, convert the garage, put a second story, throw another door in there. You know what I mean? Like try to bootleg a unit, whatever they're going to do. Because if there's only so many single families in that neighborhood and you're trying to maximize your rental cash flow, the city will allow you to do those things, except when you go to get financing on it, you shoot yourself in the foot. Because when you were qualifying somebody, it's cash, credit, income, property. Okay. Cash, credit, income, property. Cash, credit, income.
Are you good at the piano? Because the way you just move those fingers is perfect.
Spin my house. Let me get down.
I got you.
But the property one is the one that people have been taking for granted for a while now.
Yeah.
And the reason I say that is because before we had a lot more available inventory. So you had much more to choose from when you're trying to do your valuation. 2, the conditions of the marketplace for the property type is starting to morph. So now you have the juniors, the ADUs, the duplexes that are now having ADUs in there. We don't have enough of them yet to comp it out, but it's still a consideration. We didn't have to 2 or 3 years ago. Now I'm seeing it pop up.
Let me ask you this. Okay. When you're qualifying someone for a multifamily property, okay, forget about ADUs, just multifamily. We can throw the ADU scenario in there as well. I think it's
2 to 4 unit, right?
2 to 4. Yeah, let's talk 2 to 4.
Okay.
It's based on the income approach. Is the majority of the weight given to the income approach because they're going to be renting that out. Typically, in when it comes to real estate, single family is meant for primary. 2 to 4 is like there's no way you can live in 4 units, right? So even if you live in one, the majority of the time people are.
So
why do you say program types? Because my thing is more like, if someone's going to buy a duplex, really they're probably looking for the income. Like, I got a house, I'm starting to create my investor portfolio, the payment. For sure, right? So the majority of the weight is based on income, sales comparison in regards to
the majority of the weight is on the borrower. So their income, credit, assets, right? The majority of it starting. The additional unit next door, we get to use 75% of the fair market rent. So not the subject existing rent. So they can rent it for $1,000. If the fair market rent's $2,500, we get to use $2,500, 75% of that.
Yeah.
And the reason we use 75% is the 25% is to factor in for vacancy,
of course,
marketing, property management fee, utilities, etc. Right?
Perfect.
So then you're with 70. Now, when you start playing with program types, let's say a 4-unit on conventional versus a 4-unit on FHA. Okay. So a 4-unit on conventional, just out of the gate, you're 25% down, period. FHA will allow you to purchase with as little as 3.5% down. However, they have an additional qualification requirement, which is their self-sufficiency. Okay. So they call it self-sufficiency. We call it debt service.
Okay.
Their debt service ratio is 1.15. So if you were going to buy a 4-plex, we would take 3 of the units, take your income, that qualifies for the loan. That's one qual. Then we say all 4 units, total gross, no vacancy, just total gross, right? And then we'll say, okay, at 75%, does it cover the note at 1.15? Okay. So you can collect $9,000 a month at the end. Let's say it's $12,000 minus 25 is 9, right? 9. Your monthly payment probably cannot exceed somewhere in the neighborhood of $8,100.
Okay.
7,800, give or take.
Give or take, minus 15% of that. Okay.
So it's 1.15.
Yeah.
115% of the payment.
Correct.
Right. That's the maximum. And if the property does not meet that ratio, you can't get financing on it.
Got it. So, okay, perfect. So it's definitely based on the income.
Yeah. Or you have to put more down payment or buy the rate down or something to that effect. Right.
Okay. Because this when I perform an appraisal report for a multifamily, we do both approaches. We're like, what are all the sales in a neighborhood? One. That's the sales comparison approach. And then we go, what is the income? Well, we find the GRM or a few commercial guys out there, the caps, the GIM, all those things. So we're utilizing a monthly rent, sales price, and it spits out a 3-digit number. But it's based on the income. And the reason why I asked that is because a friend of mine was getting a loan and she was trying to figure out the appraiser based it all on the sales and nothing on the income. And I was kind of like, well, that's a first, because
I say that often. I actually say that often because, here's, and this is different schools of thought. I even think for like the valuation side, the available financing for a 4 units and below for residential financing is much more abundant than you would be in a commercial.
Okay.
So a 5 unit, you'll see 5 units valued and sell for less than a 4 unit property. Because on the 4 unit property, the buyer themselves is using their income to qualify for that monthly payment. Mm-hmm. That's a portion of the qualifications.
Okay.
When you're buying the 5 unit, you're essentially buying a business. So there's nothing really from the borrower standpoint you can make $2 million a year, but if that property doesn't debt service, they're going to be like, hey, Sid, I need you to put another 10% down because it's not covering the debt service for what you're doing.
It's all the same. I mean, the income is the income. So on a 5+ unit, are they still utilizing 75% or is it 100% of that?
Well, the reason I'm saying is that on a 4 unit, it allows prices to get pushed up higher outside of the income calculation. So the income approach is one method, right?
For sure.
The 5 unit would be income approach. Mm-hmm. The 4 unit would also have an income approach, but then you also have the 4 unit comparable sales approach. Mm-hmm. Case in point, Pacific Beach,
okay,
or Talmadge. Okay, you're in a neighborhood where the value or the price of the property, you're going to put damn near 40% down just to make it break even, right? But the only way somebody was able to pay that price for it was because they were able to get the capital to be able to get that price. And you have more of them for comparables to justify that value. When you look at a condo project, if you look at a condo project, Riverwalk here in Mission Valley, mm-hmm. South, or actually the North Complex, mm-hmm. has available FHA, VA financing, different HOA, right? Side-by-side community.
Yeah.
Identical.
Yeah, they are.
Okay. This neighborhood, a 2-1, 425. This, right across the complex, you can stare out your window, look at this complex, that one, 325, 350. Because this one was not managed as well and doesn't meet the qualifications for Fannie Mae financing and FHA financing. They got killed on it.
Yeah.
Because whoever was running that HOA didn't bring the balconies up to code.
Yeah.
So they had to reassess all the homeowners $9,500 in order for them to be able to have enough capital to fix the
good luck getting
the
that
balconies.
from 1,200 units.
It's going to take them, it's like 350 units. So it's going to take them probably a few years before they get enough reserves to be able to do the repairs required. But the price difference from across the street, from this side to that side, is a good 50, 75,000 easy.
Mm-hmm. In a market that we're in right now where rents are through the roof.
Yeah.
I've seen it utilized from a realtor perspective as an incentive to buy this product because of the amount of rents that this property is going to get or receive. Even based on the 75%, the projections are much higher most of the times that I see than the sales comparison approach. So let's say in any given neighborhood, mm-hmm. the sales for a triplex are, 1.65, mm-hmm. but the income that it generates is 1.8.
It could be.
You know what I mean? And so it really starts to look at what's the driving factor in this market area? It's the income. It's not necessarily the product, because you can, based on the income, it's to incentivize someone to come in and go, hey, we'll sell it to you for 173.
Yeah, because you're still looking at cash investor standpoint. So when you're looking at like a cap rate, mm-hmm. cap rate doesn't include principal and interest in its ROI.
Yeah.
Right? So ROI is the return on investment, right?
Of course.
So that's under the assumption I'm going to pay all cash for this place. I'm going to get 3.5% rate. This is funny. I'm going to get 3.5% rate of return.
Yeah.
Right? As soon as you add a loan to it and you're like, whoa, I'm going to lose money every month because I'm paying 7.5% interest rate. And I got to, just to break even, 50% down. Well, because half of 7 is 3.5.
Yeah.
Therefore, you're only getting X amount of money, bro.
We like to use real basic numbers here, guys.
Yeah. This is like elementary math. Okay. But that's kind of my point, though, is that when you're looking based on a cap rate calculation, it's based on an all cash buy versus the cash flow calculation with debt servicing included. Your typical homeowner that's going to live in one of the units, the reason they're doing a duplex purchase is because they're trying to use that duplex to help them debt service.
Yeah. Okay. That makes sense.
Right?
Yeah.
So it skews the numbers a little bit.
So we've talked about two approaches, the income, the sales comparison. And then there's this thing called the cost approach, which is like replacement cost new or reproduction.
Yeah.
And I was having this meeting with my team today.
Anybody on the HOA board, you might want to listen to this. Just telling you in advance, if you have a condo.
Tell them.
If you have a condo, get to your HOA board ASAP and have them start doing a brand new replacement cost analysis.
Yeah. Because
when you had your budget set up, it was based on the valuations of the cost of materials from pre-COVID. And it could be 75% of what it is today.
Yeah. Matter of fact, I'll caveat with that by saying I increased my insurance about for my primary home about 6 months ago because I was looking at I go, okay, you're telling me replacement cost is this, and you're telling me this is what I go, it's too close. I go, what if there's another pandemic? What if just at the rate everything continues to rise? I go, I'm not going to be able to rebuild this house for the price that you're saying. And then they go, oh, well, we have this other supplement. I go, just raise it. I'll pay more. Doesn't matter. Just raise it. And I'd rather have more comfort room. Now, here's where it becomes really important. In California, Florida, Texas, a lot of states within our nation, insurance companies are pulling out, right? Especially in a state like California where they can't raise premiums at the rate of inflation or whatever.
There's restrictions involved.
So, in layman's terms, maybe you guys are not in real estate, you just like our voices, and you're like, what are they talking about? If you bought a car, let's say around the pandemic period, and you bought a $40,000 car, right? And then 8 months later, that $40,000 car is worth $50,000.
Yeah.
So let's say you get in an accident, and now the insurance company is insuring for you, but they have to pay out $50,000, right? So imagine that in a house. And so what I was really trying to, every week we have a different topic. This when my guy Bernard was like, cost approach, I go, oh, let's get into it. So we really started deep diving into cost approach and figuring out cost new. Now, here's what I want people to really understand in regards to that. The importance of the appraiser during discovery, I like to call it, right? Discovery. I feel like we're attorneys. Is when we call and we go, hey, Mr. Smith, we're going to come do your appraisal. What have you done to your property? Oh, I did a complete gut, new foundation, all these other things. Sometimes people just go, okay, great, sounds good. Let me just go on the MLS and find out other homes, which is proper. Let me see other homes that had new foundations. We need to do that for comparison states, right? But what's even more important is, what is the replacement cost for this? So then we started playing around. We use Marshall and Swift. We started playing around with Marshall and Swift. There's all these other ones like CostNet and all these different things. But Marshall and Swift across the board is like a standard for our industry. And then I started going, okay, we value this property, I think, for 2.5 in San Clemente. And then we started playing around the cost approach, really looking at our notes and seeing. So it started at 1.8, and then we started going to foundation. Well, it's a new build. They rebuilt this property in 2019. So we were like, okay, it's extremely, let's say it was extremely good. Let's just put it like that, because I forget how superior. It's all superior, right? And so we changed that. You start changing, you see the dollar starts to change. It went from 1.8 to 1.87 or something. We're like, whoa, that's a big jump. And then we started really deep diving into all the specifics, the roofing, the materials, the Venetian plaster, the whatever the interior had, the exterior had. And then we got into what people don't awfully think about because you can't see is the insulation. So then I go, hey, pull up Home Depot. I told Mark, who's my ops guy, I go, hey, pull up Home Depot. Go to R16 insulation, bat, just standard insulation. The pricing for insulation was $50 to $85. I was like, okay. I go to R19. Same site. Insulation went from, let me think about these numbers. It went from like 85 to 120. I was like, interesting.
25% jump.
Boom. Right?
Yeah.
Now on the high end, we have 50 to 85, and then on the other high end, we have 120. Mm-hmm. Then I go to R30. Then it went, R30 was 140 plus.
Okay.
Right? Now, the reason why I'm saying this is when we're talking about replacement costs, not even for your primary, but the importance of our job. I go, guys, like, there's a lot going on here, because not only does the client that's receiving the report understands the value that they hold, and maybe they go, holy shit, we need more insurance, right? Because to replace this property today, yeah, we built it in 2019. To replace it today, it ended up being like 2.2, almost 2.2. Let's say 2.85 or something like that. But we value the property at 2.5 and change. So not only can the lender look at that and going, oh, the asset is worth more than what the replacement is, which is huge, right? Because what if that was just upside down? What if to replace it was 2.7, but the value is 2.5? The lender may look at that and go, this is a risk, because if something happens to this, we're not getting anything really back for it, right? So then I start looking at it. So it's almost 2.2, the value is 2.5, and I go, so it's like our job is so important across the board, because it says so much to so many different parties. We call that the intended user or users.
That's right.
So it could be the lender, it could be the secondary market when they sell that loan off. It's the buyer themselves or the refi market, and going, okay, this is what we have. And I go, and that's when I was telling my guys, it's one thing to conceptualize it. It's another thing to be articulate that. Now you can go to a group of 50, 1,000, 10,000 and talk about that.
It's really simple if you think about it, right? So you have an investor standpoint where it's worth something to me because of how much I'm getting back in my rents.
Yeah.
That's what it's worth to me. This is my investment.
Yeah.
It's worth it to the agent at the highest price. Because why? Because they want to get the most they can for their commission. They're looking, but look at the prices. Look at the prices.
Yeah.
Right?
Yeah.
And then you look at the lender. The lender's looking at the risk of the replacement and the insurance company.
Yeah.
Right? Because they're like, okay, we're going to ante up this money. We're the ones taking all the leverage and risk.
Absolutely.
We want to make sure that our note is covered if we have to get this place replaced.
Yeah.
So 3 different interested parties involved, 3 different
and
reasons.
The borrower, if you consider the borrower an investor, yes, maybe no.
Yes, maybe, but you know what? But for them though, I mean, no different than your brand new car.
Yeah.
If you buy a brand new car, you drive it off the lot and you get hit right away.
Yeah.
You're not going to get the price that you just paid for it before you drove off the lot.
Yeah.
Now you got to get gap coverage.
Gap, yeah, for sure.
Right? So from a person who just spent $2 million building this luxury house in Encinitas and something happens to that property and they don't get enough coverage.
Hurricane Hillary. You know, if Hurricane Hillary comes by and just destroys that. Right. That was the thing.
But does that make sense though? So
Yeah.
I get that. I think where a lot of people are really kind of falling short and not necessarily seeing, I was talking about the whole condo thing.
Yeah.
Is that when you have boards and you have people involved, that the bureaucracy takes a little longer. And I've seen this happen during the crash. So when you started having properties during the crash that were a lot of bank owned, then people weren't making payments to the HOA.
Yeah.
Then it affected the reserves. Then you had a lot of inventory sitting in the market and it started dropping the values. And so the HOA started suffering. When the HOA suffers, like I said before, cash credit income property, the lender still needs to validate the property that's going to conform to the guidelines of the lender. So FHA has their regs, VA has their regs, Fannie Mae has their regs. And so, case in point, when we do our condo review, so you're putting less than 10% down, or maybe we get insurance coverage for your condo project.
Yeah.
And your condo project, the master insurance hasn't kept up with the replacement cost. You're stuck.
Yeah.
You can't get that loan anymore. It now becomes a non-warrantable condo, or you got to find a different product that'll fit.
So it's like being under litigation, so to speak, where you're like,
correct.
Yeah.
Yeah.
Okay.
So now, in order to sell that property in the current market, in the current state that it's in, because now you can't get the traditional financing, you're going to have to drop the price enough where somebody's going to either pay it all cash, or an investor's going to see, 20% down, I'll totally buy that with a non-QM high interest rate loan.
Yeah.
That's just the insurance aspect. Now you start adding more layers to it, because the fire zones, Rancho Bernardo, Vista, San Marcos, they're not having sufficient coverage for those kinds of things. Or their reserve study, when they just did the last one, wasn't, because you're supposed to do them every 3 years, I believe, for HOAs.
Okay.
The last one was done pre-COVID, based on pre-COVID pricing. They get it again today. They don't have enough.
Yeah.
Now, when we're looking at the ratio, how much is in your reserves? How much do you need to have? Oop, now you're short.
Yeah.
And in California, the HOA can only raise insurance a certain amount per, unless it's an emergency, or they can do the reassessment to each of the homeowners and put liens on everybody.
Yeah.
It starts to affect the financing. So my 2 cents is, if you don't have a good lender that knows how to explain some of these nuances, especially to a board, in the long run, if you can't sell the property with the traditional financing that's available for it,
Yeah.
it's going to devalue in the long run.
Do you do that? Do you go to HOA boards and have these sorts of conversations?
Back in the day,
No more?
No, because back in the day, it was self-interest. So when I was buying condos from Fannie for like 55 grand, 75 grand, 80 grand, I'm on the board.
Yeah.
Yeah, because I knew what the problem was.
Yeah.
I'm like, hey guys, in order for us to be able to get the values up in this place from my 85 grand, we need to make sure that X, Y, and Z is taking place. And then if I saw back then, because a lot of developers were stuck selling properties, so they have, like, we had this one place in Spring Valley, Casa de Oro. One developer owned more than
10%.
It's like 15% of the project.
Yeah.
And it makes total sense to them.
Well,
They're like,
sometimes if it's like 3 units and you're like,
well, if it's under a certain percentage.
Yeah,
but
for
my point is that for that specific case, the developer didn't want to sell those things because he was going to take a loss. So he's like, hey, you know what? Here's what I'll do. I'll rent them out for the next 5-10 years and let the market recover. And then eventually I'll sell them so I don't have to take the loss today.
Yeah.
Makes total sense.
Of course.
Unfortunately, every other 85% of homeowners in there are going to be subjugated to the decision that guy made. Yeesh. So on the board, ring, ring. Hey, how's it going? Hey, you want your property values to really go up really quick? Here's what I need you to do. We're going to take 5 of your condos and we're going to plug them under one LLC. $800 for you, my friend. And then we'll take the other 5 units, 5%, and we'll put them in another LLC. We'll call it, Joe Smith number 2.
Yeah.
And then we'll put the other 5% in another LLC, Joe Smith number 3. Cool? Because as soon as you do that, now legally and truthfully, I can say, does one entity own more than 15%? No. Problem solved.
Wow. So let me ask you this. So at what point in the...
And no, I'm not going to help you with your HOA.
I was gonna get him on tour. I swear, like, starring.
I can hear your mind thinking right now. No, but the problem solving, just like I mentioned with the ADUs, lending needs to have a voice in a lot of that, because it does. And what you do, you're just giving us the information and the intel. We need to help give them the answers to the test. That's all.
Okay. I thought I was giving them the answers, but maybe not.
You're giving us the building blocks.
Yeah, for sure. When in the process is that figured out with the HOA? Let's say you have a client goes, I want to buy this condo.
So based
when do you go like, oh, you can't buy that because they don't have enough reserves, or?
That's a great question. So the majority of the time is going to happen in the front end. So in the very beginning of the start of the process. So if you're going to buy a property, let's say you're using FHA financing and the project pre-existing is not FHA approved, we're going to do a spot approval on that HOA. So now that project, because of the loan type we're trying to do, we're going to collect all the condo docs in it: minutes, budgets, bylaws, reserve study, title prelim.
Meaning like, okay, I've identified a property. Can you send me the approval letter, and then you guys get to work on, is this going to be?
Try to make it work.
Yeah. Okay.
Right? Because just because the client, maybe they're qualified under an FHA program as an example, and the project is not FHA approved on their pre-existing roster, then as a lender, what we can do is do a spot approval.
Okay.
We'll get that project to be approved on HUD's website.
Oh, okay. Got it.
But because now we're getting it approved on HUD's website, we now rep and warranty that HOA. So if another lender goes in there and does a transaction and they're relying on the approval that we did, that could be a problem.
Yeah.
Because now we're compounding. So that's why the lenders are doing due diligence. There's 2 types. There's a lender approval, and then there's a HUD approval. So HUD's issuing the full approval. They underwrite it. Yep, this meets our guidelines. Versus us doing it through our own condo department saying, oh, meets our guidelines. Cool, good to go.
Yeah.
We'd rather go through HUD. Takes a little longer.
For sure.
Go through HUD. VA, same process. Conventional is done internally as well.
What are those? Because sometimes I hear like, oh, it's VA approved, not FHA, and I'm like, okay, what exactly is that? Meaning, FHA has more of a stricter process, or
no, because FHA has expiration dates. That's the only one of the really good benefits about VA.
Okay.
Once your condo project's approved, whether it's a pile of crap or not, you're buying a lemon, it's on VA's approved list.
Got it.
If it's on FHA's, they have to resubmit typically every 4 or 5 years. They have to resubmit for that.
Okay.
So we see expirations happening. Downtown was a great example. Downtown, we couldn't do a lot of that kind of financing after the meltdown because all those HOAs were trying to recoup money from the builders, developers. So we had that construction defect because it's a 10-year gap, right? 10-year window. And prices stayed depressed for a really long time.
That's always a weird thing with downtown. You know, it's like, I wonder, I'm pretty sure the developers, builders build that into their pro forma. It's like the 10-year defect thing. Because it's like every single building. And you're like, are you kidding me? You know?
Yeah.
I have a buddy that lives in a Treo, and he sent me a photo of what the pipes look like. And I was just kind of like, you got to be kidding me. You know? And obviously it's not the same pipe that goes for your shower, but it just didn't look good. He goes, that's what we're dealing with throughout the entire building. And
you'd be surprised. I bought a condo in Temecula.
Okay.
And the contractor that did the soldering for all the pipes, bro, I don't know what solder they used, straight China solder.
Yeah, for sure.
Like, I don't even know what solder.
Along with the drywall and everything else. But yeah.
Dude, every building, because there were like clusters of like 8 and 10, it was just like 1 month, this building started cracking leaks. Another month or two passed, the next building started popping leaks. Like, it was deteriorating over time. And I was
how new were those at the time? Like a couple of years, like 5 years, 10 years?
No. I mean, dude, I maybe had it for like 6-8 months.
No way.
Yeah, I had just put tenants in there too. And yeah.
What do you feel about the tenant laws?
I'm concerned.
What's concerning about that? Okay, let me give you an example.
Yeah.
My buddy Jamie, he's a realtor downtown, and he does property management. And he took over a property manager. Took over a property 6 months into them they couldn't get the tenant out. Now, the tenant was like a con artist, right? Mm-hmm. So someone else rented it, they moved in. So the person that rented it did not move in, someone else did. Mm-hmm. It took them a year to get this guy out, right? Now, within that year, it's probably cost the homeowners about $100,000. Okay. So in just straight rent, it was probably maybe $70,000 in that year for rent, because you're thinking, I think they're renting it for like around $5,000. Do the math, right?
Okay.
And then legal fees and all these other things, and and they could not get someone out that wasn't even legally on the lease, right? And then you have the things on the coast that, or if you kick someone out, which is like, okay, you kick someone out, you got to pay them 2 months, which I'm like, okay, I get that, right?
They're elderly and the city subsidizes and stuff like
that.
Yeah, it's really weird.
If you're an LLC, if you're a mom and pop, it doesn't apply, but then you have no protection, right? And so it's just one of those things that, I don't know, what's your opinion about that? Do you want to say, like, it's a touchy scenario. I think obviously you want people to have housing, but I wonder, is this why people are moving more towards the MTR route, the STR, which is like midterm rentals, MTR, STR is short-term rentals for like vacation rentals, things like that?
No, but definitely. So, here's one thing though. I feel like sometimes, because you and I have been doing this for so long, and we see so much throughout the transaction type. Mm-hmm. One of the things about the lab, and the reason I wanted to try to start doing these types of things, is so we can break up the active ingredients that come together in the deal. So it doesn't really matter.
Yeah.
Whether it's mindset, whether it's appraisals, whether it's market conditions, it's the finance, it's, looking at investments, or even like we're doing our social media thing now. Yeah. So what are the things that are coming together in order to make that effective, and just dumbing it down?
Yeah, you have to.
So, and for this case, guys, in the comments below, if there were specific acronyms that we probably jumped through, not that we're trying to sound smarter than we are, it's just because this is our dialogue every day. Yeah. Ask. I'd love to hear more about it.
You know what? You know why I really like you?
Why?
Because
I speak caveman.
Nah, man. Nah. You know what it is? You're a nerd, you know, and I like I like that. And I'm like that as well. I like the deep dive. We have these conversations and I swear I'm like, okay, you know, like it's because look, if you're not going to get all into the knit and grit, this isn't for you. Yeah, you might sell a house, you might do a loan, it's not for you. You have to really be in this, right? Yeah. And I love, let's say, a down market, a bad market, because it thins it out. People go back to whatever they're gonna do. Fine, go, which is fine. You know what I mean? But it's like when the dust settles, you go, okay, those are my peers. You know, those are the people that I can rely on for good information, on investments, on approaches, and.
Do you remember when we met one time? It was at La Jolla multi-million-dollar house, and I shared with you the story of the monkeys.
Yeah. Yes. Yeah, man. I repeat that story.
Shut up.
Yeah, I do. I repeat that story, man.
All right. I'm going to share with you the story of the monkeys.
All right.
And this is something that I still take like day to day when I see things and question them, right? Mm-hmm. So the story of the monkeys is really basic. Back in the 1950s, they say there was a group of monkeys. They took 5 and put them into a lab, and they put a ladder and they put some bananas on the top of the ladder. Mm-hmm. And when the monkeys tried to climb the ladder, they sprayed the other 4 monkeys with cold water. As each time a monkey tried to climb the ladder, they get the cold water. Eventually, the monkeys would grab the monkey that was climbing the ladder, pull him down, beat the shit out of him. Nobody climbed the ladder anymore. Mm-hmm. As time progressed, they would trade out one of the monkeys, bring in a brand new fresh monkey that's never been sprayed with cold water, immediately would see the bananas at the top of the ladder, would try to climb the ladder. The other 4 monkeys would grab that monkey, beat the shit out of him, and don't go up the ladder. Mm-hmm. They kept doing this until eventually they replaced all of the 5 pre-existing monkeys. Not a single monkey was in the room that had been hit with the cold water.
Yeah.
Right? And the reason I use this analogy so much is because it just takes one monkey to take a step back and ask questions.
Yeah.
Right?
Yeah.
And I think that until we get to the point where we start swallowing our ego and not just take everything as gospel.
Yeah.
Especially like in what we do.
Yeah.
I would say, that sounds good.
Yeah.
No, that makes total sense. But I'm going to also want to verify, because there's been many a days where the way we interpret guidelines in the lending, one underwriter coming from a large institution is looking at it one way, because that's the way they've always been told, or they rely on memory. This is the way we've always done it.
Yeah.
This morning alone, Fannie Mae just changed the major guideline. We used to use Freddie Mac for 1-year tax returns if you've owned a business more than 5 years. It's a nice little hack. So COVID year, I can toss that out. The next year was a great year. We're going to use that one. How long you been in business? 7 years. Awesome. I don't have to average those 2 years out.
Yeah.
I would specifically go Freddie Mac because of this income condition type. Fannie Mae just adopted that. So if I have an underwriter that's been doing this for 30 years and is relying on the way that she, like, hey, why what do you mean it doesn't qualify? What do you mean his income's too low? We're using XYZ guideline. So you have to always be questioning things.
Yeah.
Case in point, junior ADUs.
Yeah.
HOAs. All these different things. And that's why I appreciate always chatting with you, because you see beyond what your typical, I wouldn't even say appraiser, your typical industry professional only goes so far, and you thoroughly enjoy getting into the weeds and the details of things.
I do. And, you know, I have team meetings every week with my team. Last week was another good one. Went over FHA handbook 4000.1. And I was going through our FHA reports. I go, guys, are we being like FHA Nazis here on inspections? Because what every realtor out there can do, every lender, every appraiser is, You go to the handbook online. You go to Control F. It's gonna and you do keyword search.
Yeah.
So, and here's a funny thing is like, is a crack window, does that expire does that mean it's going to be it's going to get called out for FHA? Absolutely not. A broken window, maybe something different.
Yeah, health and safety concern.
Health and case, but everyone think, crack window. It's like, if it's prior to 1978 chipping paint, if it's after, it's not a problem, right? And so it's like we're always trying to poke holes in each other, because it's like if we try to find the hole, if we find one, let's plug it. If we don't find one, great. Iron sharpens iron, and it's truly a blessing, and an honor to really be invited to do this, but just be your friend and your colleague, because it's like, that's who I want to surround myself with. People that are constantly trying to better themselves, find the holes in what they've done, do the proper research to know, like if someone didn't know that, another lender didn't know that they just changed the guidelines yesterday, the day before, or the week prior, and they're still basing it on what happened 2 months ago. Sorry, I can't do your loan. And then what happens? The person's back and you're like, okay, I'm trusting you.
Lose a deposit.
Oh my goodness.
You have your stuff packed in a U-Haul.
Yeah.
Now you got to last minute find yourself a place to rent.
Yeah.
And it sucks.
Yeah.
Find your kid's school. I mean, dude, it's a compound effect.
Yeah. You got to stay on top of your game. I guess if that's what we're saying to ourselves and everybody else, stay on top of your game.
And that was one of the things I had a person in here once, and I said, I learned this from my old boss. He's like, there's 4 criteria when you're working with people that are the universal laws. One of them is recognize the concept of a partnership. You can't take over the world alone.
Yeah,
right?
For sure.
Number 2 is wake up with a purpose, right? You can give somebody some ether, you can get them excited, but unless they wake up with a purpose, dude, they're not the right fit.
Yeah.
Number 3 is recognize change is necessary. You talk to an REO agent, talk to a short sale agent, when that stuff started to die, if they didn't go after the buyer side, which was like abundant, getting people off the fence was hard for a long time when real estate was a bad word. And then so we started working that market condition, picked up the volume off of it because we weren't sticking to what was working at the moment.
Yeah.
Right? So recognizing change is necessary. This is a market condition of change.
Oh, for sure.
Right?
Oh, yeah.
But the 4th, which any one of these is really important, but the 4th is coachability.
Oh my gosh. Brother, I'm not lying to you when I'm telling you that I had this conversation today, and I always speak about that. I've hired friends. They say like family shouldn't work together, friends shouldn't work together. It's not that. It's when we come together, we all raise our level of professionalism, right?
Yeah.
My particular friend, he had the hunger to learn, but did not have the hunger to be coached. And you need both.
Yeah.
And I swear we can go for another 2-3 hours on this, right? But I love what you're saying, because it's exactly what I was just saying, not even today. And it's so interesting that it's a part of the makeup, right? I mean, it's something, what's your purpose? I asked them, what is your purpose? When you wake up, what are those top 3 things that you say, I need to get this accomplished today? What is your end goal? Let's reverse engineer that. How do you get there?
Yeah.
Right? If you don't know that, and you don't wake up and go to bed saying, I did this, here are my next 3 things when I wake up in the morning, what happens? You just wake up and it's just like, I don't know. I have no direction. You just kind of I don't know what you do, right?
Yeah.
And so I think those are the little things in life, not outside of real estate and family. It's just life in general. Like, what are you going to do tomorrow? Right.
Well, especially in this market. In this type of market condition, you need to dig really deep.
Yeah.
And grind.
Yeah.
Like, you just need to do it.
I think in every market though, right? Good market, market, bad market.
I just had this conversation with my wife.
Like,
see, the thing is that the reason I had this conversation with my wife specifically is when she would stay home for 12 years. So when she talked to me about the business and she saw me stressed and she's like, you have too many loans, you got too much business, you're stressed. You don't have any loans, you don't have enough business, you're stressed. It's like, what is it? Right? And I'm like, well, it's both. Because regardless of whether I'm swimming upstream or swimming downstream, I'm swimming as fast as I can.
Yeah.
Different.
Yeah.
So when looking at this type of business, if anybody were to get into real estate, lending, title, escrow, appraisal, realtor, commercial, doesn't matter. you have to be willing to run a marathon regularly.
Yeah.
Regularly.
Always be training.
Always. And you have to put 100% in, whether you're running uphill or running downhill. Yeah. Where we make the mistakes is when we get really cocky and we trip on our shoelaces, is when we start cutting corners. We didn't tie that extra knot. We're running downhill and we start getting cocky because we feel like we're faster than the average bear, but not recognizing that we're running downhill.
You still have to put one foot in front of the other.
You still got to put one foot in front. Because, even when you're running downhill and you run faster than your feet can move, you're going to fall.
Yeah.
Right? And that, to me, is ego. That is ego. I've seen it with the best of agents get a bunch of business really fast because they were doing the right thing. Now their socks don't smell. And it's amazing how people no longer want to work with them because of their attitude of not of the industry, of life in general.
Yeah.
Right. So, thank you for coming today, bro.
Yeah, man. Let's do it again soon.
We are going to have you again.
Yeah. This will be fun.
Yeah. I'm going to do something, down the road, relatively soon, cause I have the other studio still.
Yeah.
And so, you're talking about like foreclosures and things like that. So I'm going to have Sky on, Sky Schuler.
Oh yeah.
He's like the number one attorney in town, like the dude.
Yeah.
Right. So he's like, yeah, bro, I'm all there.
Yeah.
Yeah. Yeah.
Yeah. I love Sky.
Dan's going to come in too.
Sweet, man.
Yeah. I got some gangsters coming in, but I think it's important for us to also aggregate information from different people within our industry, because like you mentioned earlier, there's different parties involved with different interests involved.
Yeah.
And I feel it's so important for us to be able to get the message out in the way that we're seeing it, from the angle we're seeing it at.
Yeah.
And that gives anybody else an idea from a different vantage point, makes them that much better.
I love it. The lab.
Awesome, brother.
Nice. Thanks, man. This is great. I love
We're
this.
out.